Well, thank you, and great to be back here on the stage for a topic that I think is close at heart to all of us. I had some slides, but I don't have a zapper. That's okay. I can do it without as well, no problem. Well, first, maybe let me quickly introduce to you Ageas, because I think it is important, our profile, to understand my comments that I will make on regulation. We are here we are. We are a listed insurance group with home base in Belgium and a heritage of 200 years, and that's almost literally 200 years because next week we will celebrate our foundation in Belgium in June 1824. And so with this we are even 6 years older than the country itself. We offer retail and business customers life and non-life insurance to suit their specific needs, and we also are engaged in reinsurance activities. We have businesses in Europe and Asia, Belgium, UK, Portugal and Turkey, combined with 9 countries in Asia, and there we work mainly with long-term partnerships, with very strong local financial institutions and key distributors, and that will be an important element to remember when I talk about regulation. We are really a company with partnerships, as I said, in Asia. It is really a part of our DNA, and it forms part of the model how we develop and grow insurance around the world. In all those markets where we operate, we are among the market leaders, and eventually we represent a workforce of 50,000 colleagues around the world, and we have an inflow of 17.1 billion euros. So that gives you a little bit an idea on who Ageas is. Well, let me start by emphasizing that compliance with law and regulation is of the utmost importance for insurance companies. Financial institutions, they are still the backbone of our economy. They manage our hard-earned savings and provide essential protection in society. And to maintain public trust and confidence, insurers do adhere, I would say almost naturally, to strict compliance standards. The sector demonstrates integrity, transparency, and a commitment to ethical practice. Without trust, the insurance company can simply not exist. Customer trust underpins everything we do as a business, and it determines what we sell, both in the short and in the long term. And consequently, as you will appreciate, safeguarding that reputation and maintaining our credibility is of a paramount importance, and insurers, they do know this. But with one leg in the EU market and another leg in the Asian markets, Ageas faces here some unique challenges. First of all, the regulatory environment for insurers in Asia and Europe, they differ significantly, with the EU adopting, I would say, a more consultative, a more transparent approach, engaging stakeholders extensively before passing new legislation. And that's a process that allows for a little bit greater predictability, for a smoother compliance for insurance, while in contrast, some Asian regulators are more inclined to impose regulations at short notice and often with an immediate effect and far less stakeholder input. And that can disrupt operations and create uncertainty. But on the other hand, EU regulations more and more, such as GDPR and CSDDD, increasingly have an extraterritorial impact, requiring global compliance, raising standards worldwide, further illustrating EU's far-reaching regulatory influence. And while there is no doubt that market regulation and supervisors significantly contribute to safeguarding credibility and trust, continuous attention is required to avoid disrupting a delicate balance between the need for stakeholder protection and the drive for competitiveness and innovation in our industry. Excessive over-regulation undeniably wields influence over global market dynamics. Unfortunately, the number of priorities and associated levels of requirements have been steadily increasing. And if we look at the insurance sector, well, historically, after 2008, attention was primarily on corporate governance and prudential supervision. Now, efforts have shifted towards compensation for the consumer knowledge gaps, addressing the well-known concept of information asymmetry, to understand a better and to ensure them that they have a better understanding of insurance and financial products. Let me now, for the panel, introduce, I think, 4 topics for the debate. First of all, in addition to a very insurance-specific need for regulation, of advancing all the time that European legislative process, we see more and more a surge in cross-cutting regulation. And this trend is a logical response to evolving risks which are global across industry, such as data usage, GDPR regulation, digital operational resilience, DORA regulation, European Green Deal, CSRD regulation, Corporate Sustainability Due Diligence Directive, CSDD regulation, and even advancement now in artificial intelligence and machine learning with the AI Act regulation. However, these cross-cutting frameworks are not tailored to the unique aspects of the insurance sector, and they result at times in duplicative or overlapping and even more straightforward conflicting requirements, as insurers are already subject to extensive regulations that often aim for a similar outcome. Regarding the latter, this challenge, and it was already mentioned today, has been recognized by EIOPA, with Mrs. Hilkema noting that EIOPA has advocated against categorizing insurance as a high-risk sector under the AI regulation. Second, the EU's regulation, GDPR, CSRD, CSDDD, increasingly have an extraterritorial impact. And for us, that means Europe and Asia, requiring global compliance and raising standards worldwide, further illustrating the EU's far-reaching regulatory influence. And while Europe succeeds in driving global change, fair attention should be given to a balance between setting the standard for the world, combined with local priorities that other countries might have, and global competitiveness. Here I can say increasingly, our local boards and our board members in our Asian operation facing conflicting regulation. And after spending a lot of legal fees to analyze the situation, often we only come to the conclusion that compliance is technically impossible on both sides of the world. And sometimes, in some cases, that even goes up to the personal liability of the directors itself. I think this situation is not sustainable for the future. Third, more and more, compliance with regulation reaches also beyond the own organization, up and down the value chain. And this way, financial institutions are given the role to create a viral effect in change. And while insurers do accept their moral duty as a key actor in the economic fabric, carrying the formal responsibility over the value chain is very costly and is inefficient. Value chains are not straight lines anymore. They are networks, meaning that after a while, everybody is controlling everybody. And fourth, altogether, these significant challenges arising from the political and strategic shifts means that organizations like ours are confronted not only with a high volume of regulatory changes, but also with increasingly complex expectations and exploding reporting requirements. We have to consider the impact. We have to consider what is the negative direct and indirect impact on customers. More disclosures is not always more transparency. Productivity gains that we all enjoy and we have been working hard for, from digitization, from data and AI, they should be equally shared among stakeholders. And that also includes our customers, where today a major part of our efficiency gains goes to the increasing cost of regulation and reporting on top of the cost of risk. And the cost of risk, that's why we are in business. So our customers should also be able to enjoy more of those productivity gains. We can only commend the European Commission's promise now to reduce the EU's reporting burden by 25%. And with these 4 elements, ladies and gentlemen, I can say that in the latest risk heat map that EGEAS collects from all the operating entities around the world, regulatory risk scores 4 out of 5 already for 3 of our 4 European countries. And 4 out of 5 means regulatory risk is at the same level for us today as climate risk and as the risk of interest rates and inflation. And to prove, but I'm not going to take time for this now, we have done these 4 elements, we have tested these 4 elements and comments on the subject of sustainability and climate change regulation, as well as on the upcoming AI and tech regulation. Happy to share that with you, but I'm not going to zoom on that right now, just for the sake of time of the debate. So let me conclude, and ladies and gentlemen, our societies face important challenges like climate change and an aging population. New risks arise at the horizon, driven by tech, by data and AI. And as we contemplate these challenges, it becomes evident that the partnership between companies and governments hold immense potential in shaping a regulatory landscape that contributes to the greater good, both for the financial markets and for the end customers at the same time. There is only win-win or lose-lose in this conundrum. There is no win-lose. Transparency, accountability, business ethics, impact regulation and agility emerge as key pillars in this collaborative effort. However, the discussion is not over. The discussion does not end here. There is enormous room for improvement, and it opens the door for further exploration and dialogue. And now I am hopefully as eager as you are to hear the thoughts of our panel in the debate. Thank you very much.